Switching under. He be like, nice coat, white coke. How you live with that smoke? Hop in, jog in. I'm just kidding, I'm broke. Sit a lot, I've been waiting for the day I don't get my pay. Check will make me happy instead of me getting laid. Never done in the middle with a gun. Put a hole in his chest, put a torso don't fall right. In the sun, but until the desert does, we don't have no fun till we chillin' at my graveside. I'll be wishing I'm dead. I've been missing my friends. Get me out of my head. All the letters I sent. I'll be wishing I'm dead. I'll be wishing I'm dead. I've been missing my friends. Get me out of my head. All the letters I sent. I'll be wishing I'm dead.
Hello. How are you so fast, Dex? Oh, I don't even give anybody notice before I do these things. I don't know. I never know. I come together with the ideas and feel when I'm compelled to finally put it together, I guess. So maybe I should play one more. Let me see. No, I should. So I have I'm just kind of waiting till anybody else comes in. So I have this one, right?
The point is, to me, real estate's freaking easy because I look at this.
So I have the Meet Kevin where he says he doesn't know, and then there's now the Keemers one that Strongman has where he says he doesn't know anything about investing. I should have like a intro where I just splice it all together. So all these people that don't know anything. So just happen to be looking at my phone. Okay, this is going to be a quick one. I wasn't going to make this a full ETF review. I guess I could in the future. For now, okay. So I was just going to briefly talk because I know these are the hot thing right now. These Roundhill weekly dividend payers, and you see them. All the high yield people love these things now. Weekly payments, your dreams have come true, right? They all are abandoning Defiance. Now they were in Defiance. Then the Defiance funds got skipped for Yield Max. Now they're moving to these people who just keep flip flopping. So like, what are these people doing? Right here we go. More option overlay strategies of some type. Does it make sense? So top holdings. So we'll go through that first. You can see that's really it. So it's let me expand. Okay. View all. So it's you have contracts of QQQ, and you've got, this is new actually. Oh, okay. This wasn't there yesterday. So you have let's see, June 25, March 25, and then you have basically a same day contract. Okay. I'm assuming it's not the same day because this isn't updated all the time. And then you have some sort of money market, right? Cash. So that's it. This is all this thing is. Okay. It's cash and some options. So it's a nerd in the back or, in a dark room playing with options on a computer. Turnover ratio is, I think I saw 60% or something. I mean, basically their turnover is like every day. They are trading every day for this thing. So performance, I mean, it hasn't really been out long enough to really do any sort of performance. Distributions are every week. We can see that. Premium discount. I don't think they're doing it yet. Okay. So I start off, which is funny timing because the guy I talked to about Tesla, he just covered this. Actually, I'm going to get in hold of him. I'm probably going to have him come on my show again because Andrew was great. You can go watch my Tesla series if you want to watch him talk about this. So he covers at the same time I wanted to cover it. He wrote an article, which I love. He's been very negative, and he is a professional derivatives investor, and he runs a club. He literally is the guy you should listen to if you have a Seeking Alpha membership. This guy literally is a professional in this space. Okay, he's not some fake idiot that says he doesn't know how to invest and buys a bunch of high yield stuff based on the yield. So his opinion matters more than a lot of people on YouTube. Let's say yes. It's another Andrew. There's many Andrews. So different guy. Honestly, Citizen, if you message him, you could you're bigger than me. He'll come on. I bet. I've had him on twice. So he's a good guy. He has his own strategies, some stuff he does. We don't have to agree on everything. So we'll go to the highlights of what he's talking about. So he's covered all these other derivative players, right? So let's see. So he covers their strategy, which we can look at their prospectus and do. It builds a single core composition position in the NASDAQ 100, which they call the Innovation 100, which is really stupid. Whatever. They're trying to be, hip, right? All these ETFs are fighting for the same small group of dividend investors, right? It's not that big of the community. If you look at all investors, this type of investing is probably not that big. So they're all trying to have an edge of some type. These people they've emailed me. I've seen Rex Shares has emailed me and offered me merchandise, I think, for attending some stupid event. So it is what it is. So they sell 0 day to expiration. So that's where the ticker DTE comes from. They sell the calls, and then they have a long call position on the index itself. So they give it some stupid name. You've seen this probably with other YouTubers. This is like on their fact sheet, this chart. So you can see it's just like a covered call strategy that we've covered before. When I talked about the dumb stuff that Paul was doing with NVIDIA, we talked about this stuff with Tesla. It's not that complicated, right? You buy a contract, right? Let me go to mine's better. So it's just like this. It's not that hard to figure out. You you sell a contract. It's been a long day. You sell a contract for the day. That's what they're doing. And then you're hoping to God that the stock doesn't shoot up because your upside is limited, but your downside is infinite with these contracts. So you buy it, right? And you buy it, you pay a certain amount per share, and you need it to go up kind of past that. So if you pay $1, you need it to go past that to make any sort of profit. And then this dotted line represents the actual asset, whereas there is no limits to its upside. It can just go all the way infinity, and it can go down infinity. So and then if you wanted to talk about puts, you just flip this little chart upside down, and it's not that much different. So there's that. So we have this chart. So that's what they're doing. Long position, and then they're taking this long QQQ position and they're selling off it, right? So this long position is going along with the index, and then they're selling every day or trying to sell pieces of it because they're selling calls. So they're trying to call away this exposure. So here's what they're doing. I have no judgment yet. Okay. So typically, what he goes through some of the negatives. Their long positions are either profit or loss and continually based market conditions as you expect. Thus, if a short call option ends the day in the money, then instead of keeping the cash premium collected, QDTE needs to settle the option with the OCC by paying out cash to the option buyer. Since index options are cash settled, the firm isn't assigned, which is good because that would complicate matters. Okay, now he gets into this part. Here's the issue. Whether or not the fund earns the cash or pays the cash out to settle a loss, QDTE still pays the initial cash premium out to investors. So every day they will sell one of these contracts, collect the premium. Whether they win or lose their bet, they're paying you that premium every day. Okay. But they collect it and then you get it per week. Okay. We haven't gotten to daily dividend dividend payers. I'm sure that's going to be coming soon. I never thought weekly would become a thing. I thought monthly was good enough. So I guarantee you everyday payers is coming. Okay. It's coming. Okay. So here's this. It's still the same problem, whether they win or lose their bets. It doesn't matter how complicated or how layered they make this approach. They're making an options play. There's only two when you do an option, you win or lose. That's it. You win or lose. If they lose, they still pay you. Okay. That's that's the flaw of all these. I mean, you could shut me off right now. Flaw of all these option strategies that I've ever looked at. They pay you whether they win or lose. And that's why they will fail. Okay. Same thing I said about Tesla. Go look at Tesla from last fall to now. It is what it is. Okay. Let's see. So he nailed that. Now, one funny thing, I actually, by having a long position, but then you're selling the contracts only during open hours of the market. There's actually this interesting quirk I don't know if people are familiar with. So the New York Times did a study in 2018 along with economists, and they found, which is kind of wild, outside of regular hours, returns the vast majority in recent times. So this is going back obviously like 30-ish years. We're not going back 100 years. In recent times in the market, outside regular hours returns the vast majority of the gains in the market than regular hour activity, which logically, if you think about it, is not that hard to understand. What happens after hours? All the earnings happen after hours. So most of the upside, which I'm not going to claim I knew this. Did not know this until I started to research this topic, because I was thinking that this would be a negative, that they didn't have after hours exposure with this daily contracts. I was thinking in my head, this is a disaster. But as it turns out, that's not bad actually. So they have a long position out, and when they buy the long position that they have, they go outside, or they go out of the money intentionally to try and avoid, or to try and capture more of the upside of the QQQ as it goes up. So they're intentionally trying to not, or to collect the upside on the long end, right? And then they collect a premium on these daily contracts to give you your dividend, whatever you want to call it. So that actually like historically is not a bad way to do this. If you were going to do something like this, have a long option and then have like these short contracts to collect and generate income, synthetic long position, right? What they've done here actually, based on this, is not the worst idea ever. You still have not erased the fundamental flaw of these strategies, is that they pay you even when they lose. Okay. And I can look at any of these. It's always the same. That would be the one thing I would tell these funds, like, they could this be sustainable? Because we say NAV erosion and you all get sick of us hearing it. That is why they have NAV erosion. The deterioration of these funds is that they pay you when they lose. Okay. If one of these funds came out and they're like, we only pay you your dividends if we win on our strategy during that week or month, you could do these things for a long time, right? Sustainable. And what would be cool is you'd actually know if they're any good at it. And you could see, okay, this fund has paid me 5 out of the last 7 months, and this one's only paid me 3 out of the last 7 months. Okay. You could literally see which ones are being more effective in their strategies. But they pay you good, bad, or whatever outcome. And that's not good. And it's not sustainable. And it never will be. So now when we say they go to zero, some people get all butthurt because they're like, oh, it's been out for 4 months and it's not zero. It's like, well, it's not a direct freaking line to the bottom. We don't know how long these things will take to get to zero. It could take 10 years, right? It could take 2 years. We don't know. You don't know what the future of the market is either. But like QDT, or some of them have been around for years and years. They are deteriorating. They're not zero. Okay. Yes. But they're all heading that way. Okay. All right, so that's his article. You can go, I will link this if you have a Seeking Alpha article or a subscription. You can go read this. Maybe I'll have him on to talk about it too. So here is this fund. We already covered this. Now here's an interesting part. So look at what they're doing with taxes. So this is part of their documents. So it's return of capital. We've seen this before. What are they doing? They do this return of capital. All right. They're doing this because then you are avoiding taxes. They know these things. If they were actually income, if they were investment income, it's short term. You would be paying, income tax rate or normal rates. You wouldn't be getting the long-term cap gain rates. You'd be paying whatever your, income rate is. So they make it return of capital, and you're like, oh, cool, they're saving me taxes. Okay, well, what they're doing, they're returning your cash to you. Okay, that should bug you. They're just giving your money back to you while charging you fees and making, and you're going to pay taxes. But in this state, it's just going to lower the cost basis of your investment. So you think, oh, I don't care, I'm going to hold it forever. Okay. Because the idea is they're giving you your money back. So logically, the investment goes down, right? The cost basis, which means the gap between the value and your cost basis gets wider and wider and wider. So that when you sell it someday, you pay the taxes there. You're not saving taxes. You're just deferring taxes to the future with what they're doing. Okay. And you really, when you buy these funds, like you should really talk to a tax professional about these tax treatments. It can get complicated. And I think most people are ill-equipped to understand the tax consequences of these option ETFs. And a lot of them don't want to talk about taxes because I guarantee you they're not paying their taxes properly when they invest in these strategies. You can get in trouble real fast. Okay. I'm not a tax accountant, but I am an accountant. I can tell you that. So here was the story I pulled from. It's a New York Times talking about like the best gains in the market are on outside regular and then the regular hours. You can find it, New York Times. Okay, let me go. We'll pull up the Adobe file. Although I pretty much covered, there's really not much more to cover about it. Okay, so I already mentioned this. I'll just read exactly. This is from the prospectus. The funds sold call options will generally have 0-day expiration. Okay. So that's why they're creating the premium by selling 0-day options every day at the start of the day, and then they sell them by the end of the day. Okay. The fund generally sells out of these call options, expire at the end of the day. The fund's purchase call options will be struck deep in the money and have longer maturities when purchased. They're offering synthetic. That's the long exposure. They go deep out of the money because they're trying to get more of the upside. Now, so the farther out of the money they are, the less premium they collect. Okay. So this isn't like you can't sit here and be like, well, no, duh, they should go further out of the money because it's safer. Well, that safety comes with less premium generation. All right. Markets are very efficient at pricing options. So, but this is good that they're doing this. They're not being too greedy is what I'm seeing. This looks like they're trying to be more sustainable for what this is. Okay. So they're generating the premium just on this side. They could technically generate more premium if they went closer to the money on the long exposure. They could probably double their yield and get really clownish about their yield, but they've not. Okay, so that's not the worst. And then down here, as a primary means by which the fund intends to generate income. Okay, we already covered the exact same thing. They sell 0-day QQQ options. And then the other ones, it's the same strategy, just a different index. The RDTE and the XDT. It's just a different index, same damn strategy. Okay. So I mean, it's really, to do like a full review of this, it's really not that complicated, but this comes at a price to have them do this stuff. All of these, you're paying, 1%. Let's call it's 1%. Very expensive fee. I usually do not actively manage ETFs. If they're above like a 0.6, I start getting like squeamish about like that. That's very expensive. So this is kind of just, this was the one I saved from yesterday. So you can see they generate. So here, I keep forgetting to zoom in. People always yell at me. So you see, here's the short premium generating exposures, this one, 13%, right? And then they're holding a lot of the long term, a lot of it's in the longer term. Well, they call it long term, but come on, it's not even 1 year later. It's not that long term. So there, a lot of option ETFs are like this. They will take like 10% of the whole value of the fund, and they will use that to buy options to generate income. And then like 80-90% of it is some sort of long stocks or cash, to hold them down. They have to do this too because there's requirements with these things. They're only allowed so much options based on like regulations. So I think it's like 20% or something. So it's just two strategies merged together. That's all this is. It's just two strategies that they've merged. There's nothing interesting. I hate to break it to you, but is there some like art? There's a little more wiggle room with in the prospectus than like the yield max funds. So these Roundhill people have a little more playing with the numbers based on what I read when they're doing these pricings of what these options are. The yield max prospectus was very stringent. Like So that when the people like Jay's really good at this option play, is like he's even said in interviews, like he doesn't really have a lot of decision making with yield max because it's so restrictive in the prospectus. And I think one of the yield max funds, he even recently changed the prospectus to give himself more optionality about what he's buying and selling with contracts. Maybe to try and salvage some of his, asset value. So you might be surprised. Like this has performed okay because if you think about it, what would hurt this strategy? Long exposure, out of the money, every day selling, at start of the morning. So obviously, if QQQ had a big crash, that would hurt this fund. That's the biggest risk of this fund. There's something that happens at night. It's terrible. Markets open up and it's the worst of the worst, like another China yen thing, right? They buy these options first thing 9:30 in the morning. Market has just crashed overnight. Everyone's panicking. And then it starts to slowly, recover or rapidly recover. This fund's going to, that's terrible. This fund will get hurt by those events and they happen, But this year, for the most part, QQQ has been a slow trajectory upwards. So obviously in this climate, this fund is outperforming total return basis, right? But if you take out the distributions, the NAV, the stock value of the fund is down like 8%, right? It's going down and it will always go down over time. That's inevitable. And I can compare it and we can go over like option pricing, but you can see, okay, just the stock, okay, year to date, 9%, right? QDT is down 9%. I guarantee you, I haven't checked. XDTE will have gone down less because it's not as volatile. Let's see. Maybe I'm wrong. Okay. S&P's version is only down 0.3%, with the QQQ version's down 9%. It's not that hard to understand though, because SPY is less volatile, right? So you won't generate as much yield. But all these funds, it's just, I don't understand what purpose they have. I think that's the problem with all of these. I don't understand why anybody none of you need these funds. They don't solve anything. They're not necessary. I guess say you were retired, you had all your money was in QQQ. You get to retirement and you want to start collecting more income, but you don't want to be out of QQQ. You just really like it. Maybe you could start selling some of your QQQ to buy this, right? And then this would start doing options that you could just do yourself. Honestly, I would, at that point, I'd just be like, you could just do this yourself. You don't need this fund to do it when you're retired. You could just start writing calls every morning on your QQQ basket. And then on a really bad day in the market, those shares would just get called away, right? You wouldn't have a loss. The shares would just get called away. And you wouldn't have them anymore. And if you wanted to buy them back, you would experience a loss. But it would be, I mean, you could just do this yourself. This fund doesn't do anything for you. I don't understand. I think people are going to get so enthralled with the weekly dividend part. They're going to miss the bigger picture of this whole strategy. Like, is this thing the worst in the world? It's not. There's some nice things about how they design these. The deep out of the money long-term exposure, and actually based on on that article, like not having those hedged daily positions after hours is actually not bad. And you're not getting single stock risk like yield max. You're doing an index, which is better in every way. So like, I'm not saying these are yield max funds are clownery. Okay. Clownery. I'll cover another one, but it's the same as Tesla. It'll be the same opinion. Like, this is not clownery. But I don't know what purpose it serves for you or me to have these things. I really don't. And I just say sell the options yourself when you're retired. If you're not retired, I absolutely have no idea why you'd own these things. I can at least make a case for a retired person to own these. I don't understand anybody else. So now here's like some of the models that how are options? And this is what I've said before. Any options ETF that robotically buys some sort of option contract, and there's all sorts of varieties. There's ones that they buy a monthly one, right? Like the XY or QY LED, the old one, that robotically buys exposure. This one, Global X. I should do one. I'll cover this someday, but it just robotically every month they do a contract, right? And no one looks at it. It's basically automated. So there's this, and then you look at something like Devo, where there's actually a person behind the scenes making the decisions, and that's where I stand. Anything robotic or automated about options, you should get away from for these ETFs. I think options are art, and there's pricing, and like there's models that people can run. And there's times when you don't want to write a contract, right? You can look at the pricing. Here's a model of the pricing of options, right? Volatility comes into the pricing of a option. There's times when the market gets really volatile. You don't want to be doing options necessarily at those times in the market. Whereas XDTE is just going to do it every day. Every day they're going to do that option sell at the beginning of the day, even if everything is screaming to don't buy options or sell options that day because of something in the market and how they're priced. But it's got to do it because they said there in the prospectus. The only ones of these funds I'd even consider would be ones where it's like the prospectus is like there's a person, there's a basket of stocks, and this person does options on that basket of stocks that they own. None of this synthetic stuff. I think that's fine. Devo has been proven. It's got years under it now. Devo, which I have another video on, the NAV is not deteriorating. You have a person making the decisions about what contracts to write on the basket of stocks they hold. The one part that's important, it's low beta stocks, which means they're less likely to move so much. So you're getting less premium though, because you can see volatility comes into the pricing. If you're buying shit penny stocks, you're going to get a lot of premium because there's a higher risk of them moving up and down fast. So, I mean, like I said, it has some redeeming qualities. It's not a clownish ETF, these things, but I don't get it. I don't get why you'd buy this. Just buy QQQ. And then when you get to retirement, then we can discuss options of how to extract either income or what's your strategy with that huge index exposure. You have some options. This would be one of the options of how to extract income from it. But like, if you're like 25, what are you doing? This makes no sense. So I guess that's really it. I'm just going to keep saying the same thing. Again. Keemer said taxes aren't complicated. I am telling you, I've watched a lot of Keemer and seen the clips that are in Strongman's Discord, just like him. There is no damn way he's paying taxes. I guarantee you, he's either not filing or he's not, because you'd have to put away conservatively 25% of your income would have to be put away to make sure you have the tax to pay the taxes. And even you're supposed to actually make withholding payments to the government. You cannot just go to the end of the year not paying anything to the federal government and then you pay it all. You actually have to literally make withholdings. So I mean the tax, and then he's making major pay or whatever on top of this fake 10,000 a month. Like his tax bill's enormous. It's embarrassing. So they're going to hurt a lot of people. Oh, let's see. They help the Warriors retire, get 20K income, 90K for. Yeah. I mean, I should do another video about like, there's no snowball with these things. That's the other thing. Like, I don't know. I'm an old school dividend guy, I guess. But like dividends, like real dividends from companies, tax advantage status, because you get a long-term cap gain on those. So you have a tax advantage. If you didn't have that tax advantage, dividend investing would die. It would make no sense. Like that's the very first pillar of why you'd even do dividends, is that tax advantage, treatment in the United States. You pay less, 15%. But like, and then the dividends themselves, the company themselves, right, give you gains in their dividend. Like McDonald's, you might get 10% per year. And then the dividends you get start to accrue that compounding effect of the increases. These things, it's like, there's no compounding. It's just premium generation. There's nothing compoundery about premium. Premiums can generate up, premiums can generate down. The pricing has nothing to do with the whole, like here's the pricing. All right. It's macro based, a lot of it. So there's no compounding in options. I don't know why they keep going to that point, and they are going to get hurt. Citizen, oh yeah, Citizen does this good content on this stuff. So he has better production value than me. So these things always go down due to theta decay or some other reason. Well, the reason they always go down is it's just like, okay, the reason they always go down, it's, and I've talked to Propnotes about this. It's the flaw in all of these things. It doesn't matter how complicated or simple their option strategy. They pay you when they lose, and they pay, or when they win or lose, whatever their derivative based strategy is, they pay you. And that's the flaw in all of these. And so the answer is, yeah. I mean, the only way, like you were saying, well, how do they, like I was saying, how do they not go down? How do they not go down would be basically they don't pay you if they lose, right? And it doesn't matter, whatever their strategy is, a weekly strategy, daily, monthly, whatever. If they lose, they shouldn't pay you. And then there's no deterioration of the assets underlying, whether it's cash or some stocks. So if it's a basket of stocks underlying, there's still some appreciation of the underlying. Whereas in yield max, it's just straight clownery because it's just cash. The underlying is cash. So it's so easy to look at and be like, they would deteriorate. Cash doesn't really grow. I mean, cash just sitting in an account, it doesn't really do much for you. So, so basically, yeah, they're all doomed. They're all doomed. They will have brief periods of doing well, but in the end, they're all doomed. And then, like when these days come, so when these days come with whatever strategy, right? Whatever the options you're betting on. So I just pulled up, okay, QQQ. Here's the best days in the market. The best days of QQQ. On these days, you would got wrecked if you owned QDTE. You would have been wrecked. You would have gotten you would have gotten like pennies on the dollar of the gains on these days. And these days we've covered, remember I covered this long time ago, where a lot of your return from being an index long-term holder only come down to like a handful of days in a decade are what gives you your return in the market. So on those days when those things rue, if you have capped gains, it's going to damage you permanently. I covered this with Strongman. Greatest example of this. Hold on. Let me pull this. Here it is. So here was a China ETF and a China ETF, a covered call China ETF, right? Finally, you have like that long awaited day where China finally just booms, which is what these people have been waiting for now for a while. And you got none of it. With Clip, you got like 1%, whereas CWeb got 12%. All right. That's the damage of holding these option ETFs. When these days come that no one knows when they come, catastrophic loss of return, and you never get it back. You never get it back. But they're going to be like, we're not about that. We're about income. Okay. It's all about total return still. That doesn't change. So that is that. Okay. Who else? Any other comments? Okay. I want to do, wait, hold on. I think Fabio is going to go live later, but I want to do a video on Paul. It'll be a quick video, just kind of fun, making fun of him. Funny, XYLD is outperforming YMAX. So I'll cover it at some point because it's like the granddaddy of all of these option strategies. And it's very simple to understand what it's doing. And like these fund managers, the more complexity with these options, the better, because then it's harder for people to understand what you're doing. They don't want people to understand what they're doing with these options. They want you to just look at the yields and the payments they're giving you. What about the income ETF that only pays 1% a month? No NAV erosion like SP. Oh no. God. I've seen that SPYI one. I haven't looked into it. I don't even know how it's doing. I've seen the interviews of the guy running it. Okay. Hello. This man says Kemers. It's Kemers? Is it Kemers? I always feel like it's Kemer. Okay, whatever. Kemers. It's my Canadian coming through. Do you think the military will kick him out if he's not paying his taxes? Number one, like Strongman said, he's not in the military. All right. He's retired. So Kemers is not okay. I'm trying now for him, citizen. Kemers is not in the Marines anymore. All right. He retired. He's now come back as some sort of contract employee to work as a JROTC instructor. He's not in the military anymore, first of all. If he was in the military, and I can tell you this, the military would have a problem with it. If you didn't file your taxes on time, or you had tax issues with the IRS, oh yeah, you can be sure. I didn't have it happen, but somebody in my command had it with one of their privates. So yeah, you'd be in trouble. You'd be in trouble. It's not good. Wish I had paper outlaws. Got it. Okay. Kemers. I'll probably say Kemers for some reason. My brain is broken. Come here. He's teaching the youth about, like, I know. And it's even worse. Like, if you don't reinvest any of these distributions they're sending you in these option ETFs, the downward's even worse. Like, that's why it's deceptive to like do a total return on, like, if you do a total return for QDTE compared to QQQ, it's outperformed it. But then you go look at the stock, it's like, well, that's what you should care about, because the assets of the fund are what they're using to write contracts. So inevitably, as they make losing bets some weeks and then they pay you anyways, that comes out of the pot. That's less money in the pot for them to write future contracts, which means they either have to make a decision. They're either going to pay you less distributions every week or month or quarter, or they're going to have to get more risky with their contract writing in order to generate more premium to not show that they're losing. And then they're just accelerating the occurrences of losses. And the circle of, the viciousness of this is just going to get worse and worse for these things. Think of like that mall thing where you put the penny and it would do the circles before it fell. That's what would happen. Like the death spiral, the spiral, right, keeps closing in and closing in on these funds as they get closer to the end. It'll start spiraling out of control. Dex is really correct. Fine. And like, yeah, like he probably is talking to like 15-year-olds every day. And if you talk to children every day, I think you kind of, I don't know. I know some teachers, and sometimes you look at it and you're like, don't forget how to talk to adults. Like, I had a teacher, one of my kids' teachers, and they started talking to me kind of like, I almost said to him too, because I started looking at the guy, staring at him. I'm like, don't forget you're talking to adults, not just kids all the time. Because he was getting a little bit like a little mouthy to me. So it wouldn't surprise me. Apparently he's a manlet. I saw a picture. He's a little guy. And little guy syndrome's a real thing, guys. Like, I don't know if you've heard of this. I know this. So anyways, what is it? Small man syndrome. My brother has a friend. So my brother has a friend. Like, my brother and I are like 6 feet tall, basically. He has a friend that's like 5'4", 5'5", maybe. And he is such an asshole. When you go out with him, he's always picking fights at the bar, and he's mouthy. And my brother and me just laugh because we're just like, I'm going with the flow. I don't care. Like, nope. Like, one person ever tried to fight me. It's not a big deal. But like, small man syndrome or Napoleon complex, it's a real thing. Little guys get friggin' attitudes and they get mouthy, and they over project, right, to compensate for being so little. You guys make the joke, they buy like big trucks or something. They're grandiose, they're aggressive, but it's adorable, those little fellas. So any good plays discussed it. I haven't I don't know. I haven't done a live about investing. I had some thoughts about, I don't know if I'm ready to share. Okay. Made a few moves, but okay. I'm going to go away, and next up we're going to do, okay. I have to do this for historical purposes. I'm going to do a video on Paul really quick, probably 10 or 15 minutes. So thank you for watching. Hope you learned something about this fund. I don't see, unless you're retired, I don't see why you buy this this Roundhill ETF. I don't think it helps or serves any purpose for you. So that's, I guess, make it long story short. All right. See you later. Bye. Oh, gotta